In this week's video, we'll review a wide variety of data sets to help us better understand why the charts are saying there's a long-term opportunity for patient and disciplined investors. We'll be moving quickly, so feel free to use the pause button on your video player. In 2022, when the primary trend was still clearly down, we talked about in detail how to use Ichimoku clouds to help us identify what a transition looks like from a bear market back to a bull market, and from a margin of safety perspective, specifically what to look for. The cloud was red during the dot-com bust bear market, during the financial crisis, and red for much of 2022. And ultimately, to get a bullish flip from a bearish primary trend to a bullish primary trend, these bullet points need to flip. Using the same concepts to see the flip from bearish to bullish after the major low in October of 2002, ultimately, we can check all of these boxes. Green above price, yes. Price above red, yes. Blue above red, blue is above red. Price above the cloud, price is above the cloud. And the cloud flips from red to green. Cloud flips from red, and it's been red for a long, long time, back to green. And when we covered this in 2022, for the most part, all stock-related charts were over here. And thus, in 2022, we wanted to morph from this type of look, March of 2009, into the full-bore bullish look. S&P 500, exact same weekly cloud chart, dated August 30th, clearly checking all of the bullish boxes. Primary trend, up. Foreign stocks, checking all of the bullish boxes. Even emerging markets, significant laggards, are now checking almost all of the bullish boxes. Emerging market bonds, which tells us something about inflation expectations, Fed expectations, and expectations relative to the US dollar. So where do we stand relative to these points up here? August 30th, green above price, yes. Price above red, yes. Blue above red, blue is above red, yes. Price above the cloud, yes. Has the cloud flipped from red to green? It has. And we've shown charts in the past that illustrated the importance of high-yield bonds improving if we were going to feel more confident about that margin of safety. HYG, August 30th, checking all of the bullish boxes. Equal weight S&P 500, a laggard, checking all of the bullish boxes. And from a leadership perspective, prior to 2022, the clear leader was the tech sector, XLK. As of August 30th, it has reestablished its primary bullish trend relative to the S&P 500, or in this case, VU. A lot of the big names, including Tesla, now reestablishing a bullish primary trend. NASDAQ weekly, green above price, yes. Price above red, yes. Blue above red, yes. Has the cloud flipped from red to green? Yes. Another laggard, the broad Dow Jones Composite, checking all of the bullish boxes. This looks significantly different relative to calendar year 2022, when we were checking all of the bearish boxes. And all of this tells us if we're longer-term investors, there's really no reason not to be fully invested or close to fully invested in this environment. And as always, the commentary in this week's video based on the charts in front of us. If the charts and data shift in a material manner, we'll have to reassess the probabilities. How is all of this helpful? In 2022, we specifically said, these are the things that we want to see on the charts in order to feel more comfortable about the risk-reward profile for investors. And with this type of profile, we can think like investors. Given a bullish trend by definition makes a series of higher highs and higher lows, common sense tells us that if that trend remains in place, then a 100% normal and to be expected pullback will eventually be followed by a higher high. And that's a fractal concept. It's true here. It's also true from here to here to here to here. Secular simply means long term, and thus, we're monitoring a longer term trend. Common sense tells us using longer term moving averages makes sense. This chart has the simple 200-day, 250-day, and 300-day moving average. You can see within the context of a secular trend, when we go from a full bore bearish look and flip back to a full bore bullish look, with the fastest moving average, the 200-day, on top, the slopes of all of them up and price above, typically good things happen. 1958, correction is over. 1961, 1963, and 1967. The look of the moving averages and price relative to the moving averages helps us discern between periods that are much, much easier to classify as volatility to ignore and periods where it's getting more difficult to classify volatility as volatility to ignore. And some defensive action may be warranted even within the context of a secular trend. So the takeaway here, good things tend to happen when you go from a full bore bearish look back to a full bore bullish look. Secular trend window from 1982 to the year 2000, full bore bearish back to full bore bullish in 1982. Same thing in 1985, same thing in 1989, 1991, and 1995. And we also want to have tools that help us with the transition from a secular trend to a period of secular stagnation where the odds are clearly stacked against us. And in this case, you're going from a full bore bullish look on these long-term moving averages to a full bore bearish look. This really doesn't look anything like this. After this, typically good things happen. Mirror image, typically bad things happen. The peaking process, relatively early stages of the devastating 1973 to 1974 bear market, where the S&P 500 lost approximately 50% of its value. We go from full bore bullish to full bore bearish, and then back to full bore bullish after the major low that was made in October of 1974. Similar situation for the financial crisis. We go from full bore bullish to full bore bearish relatively early in the year 2008, and then bad things happen for a long period of time. After the major low, we flip back to full bore bullish with the 200-day moving average, the fastest moving average on the top, and eventually the 300-day, the slowest moving average, moves back to the bottom, and price is above all of the moving averages and all the slopes are up. Looks a lot different from this period right here that is much more vulnerable. How does the exact same chart look today? Does it look more like this, this, or this? Or does it look more like this? We just went from a full bore bearish look and just recently flipped back to a full bore bullish look. Thus, even though we're in the relatively early stages of a new trend flip, human nature and psychology tell us it's very easy to feel like I've missed it, I'm too late, I've missed the opportunity. The long-term bullish signal just occurred 46 calendar days ago. Using an anecdotal example, from this low to where we reestablish a full bore bullish look, it'd still be easy to feel like I'm late. Well, history tells us that's not necessarily the case. We're just now seeing evidence that the primary trend, the secular trend, has been reestablished. And based on investor behavior, that's very similar to what happened in 1982, 1985, 1989, 1991, 1995. And significantly different from what happened in calendar year 2001, relatively early in 2001. So we talked about opportunity in the June 23rd video, and really started talking about opportunity in mid-May on Seeking Alpha on May 18th. On June 23rd, when we first started accepting new clients because we felt like there was opportunity, the S&P 500 closed at 43.48. On August 30th, we closed at 45.14, so we have moved higher, but that's good, not bad. Because if we felt like we had a bullish setup, this is reinforcing the bullish setup. And history says it's possible that good things could happen for a long period of time. NASDAQ weekly here, the smaller chart, constructive setup here, almost the polar opposite to the concerning setup in 2022. We get the bullish breakout. Now it looks like we've come back and retested that area, and thus far we have held. Weekly momentum improving. Covered this chart numerous times in this area here, saying these were constructive setups. Setups, I might add. Setups telling us to be open to a flip from a primary trend that's down to a primary trend that's up. Holding at the center line, holding at the center line on the current pullback. Looks significantly different relative to Q1 and Q2 2022. Momentum. Holding above the center line here, holding above the center line here. Momentum, as measured by RSI, thus far making a stand above the center line. It looks a lot different relative to RSI in 2022. Covered this chart numerous times. These were hurdles that we wanted to cross. What once acted as resistance may now act as support. 2022 broad Dow Jones Composite Average, a laggard. This is what the chart of the S&P 500 looked like several weeks ago, and good things happened. This is a constructive setup. It's constructive when you have a pullback and the 10-month moving average in blue holds above an upward sloping 40-month. That speaks to the strength of the trend. Dow Jones Consumer Services Index 200-week moving average in red. When we hold above the 200-week and recapture it here, the major low is in the rearview mirror. When we hold above it and recapture it here, the major low is in the rearview mirror. August 30th, late in the session. Thus far, the pullback holding above an upward sloping 200-week. Here's your breakout here. Same chart. It looks like we've come back and retested that breakout, and so far we're holding. Covered this chart many times. Dow Jones Home Construction Index, the economically sensitive and interest rate sensitive home construction index, also demographically sensitive. For the most part, the great financial crisis kicks off in this 2005-2006 window in here. This, almost the polar opposite of what happened in 2022. Here, we give up the 200 weeks soon thereafter. Here, we hold an upward sloping 200 week. Economically sensitive travel and tourism index, back above a 200-week moving average that is trying to turn up. 10-month moving average crosses above the 40-month down here. That's after the major low. This is 2004. Bear market is OVER. Crosses again here. Bear market is OVER. Similar situation here. It appears that the bear market is OVER. Blue above red. In this case, good things happen for approximately 4 years. In this case, after blue crossed back above red, good things happen for more than 10 years. Blue is just now crossing back above red. Copic curve speaks to longer-term momentum. It is rare to drop below the zero line and then recapture it. We've only done it a handful of times. 1988, 1990, 2003 after the major low, 2009 after the major low. We covered this signal in a previous video. And the signal was flashed at the end of July, and it told us historically that we shouldn't be shocked if August was weak. And it said the median drawdown for the next month, 1.63%. The actual drawdown a month later, 1.62%. Simply telling us the weakness that we've experienced over the last 4 weeks does not negate the bullish signal, nor drift from the historical script. This table helps us with realistic expectations about how markets operate in the real world, and it reminds us that if we want to get to the right side of the table, we have to be willing to withstand 100% normal and to be expected volatility that occurs within the context of an ongoing bullish trend. And if we were to ask and answer these type of returns after the historical signals, Markets higher a year later in every case. Median gain, 20% plus. Higher every case 3 years later. Median gain just a hair under 42%. Higher in every case 5 years later. Median gain 127%. Similar story 7 years out, almost a double. 10 years out, the NASDAQ 100 up 438% is a median return. Again, these are NASDAQ 100 returns based on a NASDAQ 100 signal. And if we were to ask, does all of this align with or contradict the secular trend thesis, or a secular trend that could last until 2035? This tells us that the market, if we follow the historical pattern, and the historical pattern is based on human behavior, it tells us something that just happened a month ago. It tells us the NASDAQ 100 could be significantly higher in 10 years. That aligns perfectly with everything that we covered in this video here. You can find it by Googling the title on your screen. And does all of this align with or contradict everything in this post here dated June 12th and everything in these articles on Seeking Alpha that range from May 18th to June 7th? And relative to the term that we've been using in recent videos, does all of this align with or contradict the concept of a longer-term opportunity? Very similar concepts here, using the 30-week in blue, the 40-week in red, and the 50-week in green. Pause your video player. Ask yourself, we just flipped from full-bore bearish back to full-bore bullish. How does that compare relative to the period shown on your screen, and what happened next? And how long did it happen? SPY August 30th monthly cloud. Blue trying to recapture red. Blue trying to recapture red after the major low in 2009. Hadn't missed it. Blue trying to recapture red up here in 2023. Blue recaptures red after the major low. Cross happens in 2003. I've missed it. Well, in this case, you hadn't missed it. The S&P 500 rallied into October of 2007. Approximately 4 years here, and much longer than 4 years here. And the look of this chart on August 30th is the polar opposite to the look here, where blue drops below red in 2008 and blue drops below red in 2001, and after that, bad things happened. And as we know, none of this predicts anything. It helps us assess the probability of good things happening relative to the probability of bad things happening. Thus, until very, very recently, we had the negative setup. Blue was below red. Relative to this time frame, not a very favorable margin of safety. We're now just flipping back to the favorable margin of safety. Monthly Kopic curve just dropped significantly below zero and has now recaptured zero. Similar to 1975, 1978, 1982, 1989, 2003, 2009. This speaks to long-term investor-like probabilities. Under these conditions, erring on the side of holding positions is the right thing to do. End of August, we have a bullish PPO cross that's occurring above the zero line. What does that tell us? That tells us, from a mathematical and probabilistic perspective, this is considered to be a counter-trend move within the context of an existing uptrend. PPO is very similar to MACD. We're also getting a MACD bullish cross on August 31st, black above red that's occurring above the zero line. And we've covered this setup in a previous video. Typically, good things happen for a long period of time. Average gain 3 years out, 38%. 93% of the cases higher. Average gain 5 years out, almost 69%. 7 years out, almost 100%. 10 years out, 136%. Until very recently, it was difficult to differentiate between A failed rally within the context of a bear market, a failed rally within the context of a bear market, and the rally off the October low. Now, we've exceeded those levels. What once acted as resistance may now act as support, and we're getting a bounce at a logical area. Subtle shift on this chart. Since May, we've been holding above an upward sloping 20-week moving average. That looks like a bullish trend. Holding above an upward sloping 20-week moving average in blue. And we still have very constructive setups on shorter term time frames. Blue, the fastest moving average, still on top. The 50-day moving average, the slowest, the 200-day on the bottom. This looks a lot better than this, and this looks a lot more like the bullish periods back here. More evidence that the primary trend may have flipped in the favor of investors. BIL 1 to 3 month T-bills divided by XLK recently on the monthly cloud. It went from above the cloud to below the cloud. The only time that we've done that on this chart when the cloud was green, back here, 2009, after the major low in the S&P 500. Makes a stand in 2016, good things happen. Stand in 2020, back to risk on. Stand in 2022. This is what we look like in August of 2023. And the slope of the 50-week moving average turning back up. Slope of the 50-week moving average turning back up. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. This is Apple Weekly, made a stand above an upward sloping 200-week. That looks like a secular bullish trend in a very important tech stock. Similar situation down here, Alphabet, weekly cloud, much more constructive look. Important stock to the tech sector and an important stock to the S&P 500. Resistance, resistance, resistance in 2022. Stall and a bullish breakout. Nice looking weekly cloud for Apple. Amazon also now trying to reestablish a much more favorable look on the weekly chart. We published the first article in a long time on Seeking Alpha on May 18th. Why May 18th? Because there were a lot of good things happening that said opportunity, including risky leverage loans breaking out to the upside. This chart, August 23rd, it's a weekly chart, looks even better on August 31st, intraday up 0.5% for the week. Post from this week, you can find it either on Seeking Alpha. It's also available with no paywall or no sign-in on our blog, Short Takes. Read this article and then look at this chart. This chart aligns with everything in this article. If a debt crisis were imminent, it's highly unlikely that we'd be getting a breakout in high-yield bonds to the upside. As noted on August 23rd, it's a subtle shift, but potentially an important shift on the weekly chart of high-yield bonds. If you zoom in here when something like this happens, typically good things happen in the stock market. Late 2002, 2009, 2016, after the COVID low, 2023. If the market believed that a massive wave of corporate bond defaults was imminent, it's not likely that intermediate-term corporate bonds are outperforming IEF in this manner. Similar concepts here. When you recapture and get a look like this, typically good things happen. 2009, 2010, 2012, 2016, 2019, 2020, present day. Remember, we said there were a lot of constructive things in mid-May. This is May 25th. We covered it in a May video. This is a constructive look on SCHB divided by IEI, broad market divided by 3 to 7 year treasuries. June 2nd, a nice looking breakout here. And if we look at the same chart on August 30th, it looks like a breakout right now above these levels. So far, this looks like a successful retest. Very similar situation here. If we were going to have a massive wave of debt defaults and a massive recession, and the Fed was going to be forced to cut rates, and corporate earnings were about to get whacked, market participants would most likely prefer to own 3 to 7 year treasuries that would benefit from Fed rate cuts rather than holding earnings per share related S&P 1500 stocks. Growth-oriented SPY divided by defensive-oriented consumer staples XLP. Bearish cross here, late 2007 into 2008. Bullish cross in 2016 after the major low. We hold the 50-month moving average near the COVID low and have recaptured it in 2023, and the 50-month moving average has turned back up in a constructive manner. The 50-month moving average has turned back up in a constructive manner. This really doesn't look anything like this. You can pause your video player here, but when something like this happens, typically good things happen. Using a weight of the evidence approach, foreign stocks, so this is global stocks or all world, ex USA. So let's just call it foreign stocks. Blue above red 2010, blue above red 2013, blue above red after the low here in 2016 occurs in 2017, August of 2023, blue above red. This seems to align with that returns for balanced portfolios that occurred over the past 20 to 30 years could be quite a bit different relative to the returns in the next 10 to 15 years. Global stocks, ex-USA, call it foreign stocks, divided by TLT, long-term treasury bonds, trying to break out of a 15-year consolidation box. Very similar situation here. These are mutual funds with long-term track records. This is basically SPY divided by TLT. Recently broke out of a 22-year period of consolidation. 2021 right here, basically the exact same spot, late 1999 or the year 2000. This aligns with the concept that we're living in a different world. Higher interest rates, most likely a bias towards higher inflation, and potentially a bias towards high volatility within the context of bullish trends in the stock market. How do you handle that if you're a trend follower? You extend your time frames to account for the higher volatility, and you have to be willing to tolerate larger drawdowns in some cases, not all cases, to stay with the primary trend. Those are general concepts. From right here to right here. This is what fear of inflation, higher interest rates, and fear of Fed policy looks like. This is what today looks like. This aligns with the concepts in the May 7th tweet. May 7th, we haven't even broken out yet. Remember we said a lot of good things happened in mid-May? And remember we said there's evidence of the prior sector leader, tech, reestablishing its leadership? XLK divided by SPY, been consolidating for 2 years and 8 months. It looks like a bullish breakout and a successful retest. From a longer-term perspective, 50-month moving average, we came back and tagged it, and we've gone on to print a higher high. Monthly momentum, bullish cross on the ratio that's occurring above the zero line, telling us that this is a counter-trend move within the context of an established uptrend. Similar concepts here. We're also trying to get a breakout. XLK divided by RSP, the equal weight. Can check all of the bullish boxes on the weekly cloud. Green above price, yes. Price above red, yes. Blue above red, yes. As the cloud flip from red to green, yes. 2022 looks similar to 2020 after the major low, 2016 after the major low. Defensive staples divided by XLK, 2023 looks like 2016 after the major low. And when did this become more constructive? We covered it mid-May, May 18th. I believe that's the first date of the current round of Seeking Alpha articles. More evidence of risk-on rather than risk-averse behavior. It's a subtle difference. first time that we've held near the center line. This is almost the polar opposite of this in 2022. It's a subtle difference. 2022, look where the lows are in the box. 2023, look where the lows are. Since the October low, we made a low, a higher low, and a higher low. August 30th, 3:14 p.m. Eastern Time, it looks like a bullish breakout from a long-term consolidation box and then a retest of that breakout. This is one of the charts last week that we didn't cover, but we said we could have covered. This was the look on August 23rd. Even better this week. Tight and constructive with blue the fastest moving average on top and silver the slowest moving average on the bottom. This is the October low, trying to make a stand at a logical level. Still would like to see more improvement here, but this is the low end of the range, 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 and we are in the blue box. We would feel a lot better if we could get out here. VIX 2022, VIX 2023. Still well above the 250-day moving average in black and holding this breakout. Small caps and mid caps are laggards, but this chart looks a lot like the S&P 500's chart a few weeks ago. That similar coiled look telling us to be open to a break to the upside in mid caps. Q4 2020, QQQ divided by the equal weight S&P 500, resistance, bullish breakout, and holding above the line of prior resistance. The weekly cloud is reestablished, a full-bore bullish look, checking all of the bullish boxes. It could check none of them back here. Trying to make a constructive turn. It's not just XLK. RSPT is a laggard down here. Even the laggard has a very constructive bullish breakout, improving trend look. You can pause your video player. February 8th tweet, concepts still apply, still has a risk on look. But once acted as resistance, may now act as support. Shorter term moving average is trying to turn back up. Make an argument that this is similar to this, and this still has work to do. Constructive turn in a former laggard, XLC, and it's important because it holds a lot of important stocks. The last 2 weeks highlight the difficulty of trying to get too cute within the context of a strong uptrend. Hot off the presses from Jay, Twitter handle, X handle right here. Something that just happened. 73% of the cases, the stock market was higher a month later. 6 months later, 78% of the cases with a median gain of 13%. 1 year later, 97% of the cases higher. Average return 30.64%. Does that align with or contradict the theory that we're in a primary trend that is positive? Opportunity. And it just happened 46 calendar days ago, and it speaks to a probabilistic resumption of the secular trend. Remember, we started with when the primary trend flips, good things tend to happen for a long period of time. Also noteworthy, the concept on your screen aligns with the numerous green tables that we've covered in calendar year 2023, telling us to keep an open mind about better than expected outcomes over the next 1 to 10 years. To summarize, primary trend clearly up, not really debatable at this point, and we could withstand a lot of volatility, and this statement would still be factually correct. And thus, unlike 2022, we can take on a longer-term investment mentality. Have to have realistic expectations. The next 6 months or so, the bias should be up, but it might be volatile along the way, and if we're up, say, 5 or 8% in that window, and we overtrade, it's going to be very, very difficult to capture that 5 or 8%. And thus, tolerating the swings will most likely add value rather than destroy value. A few weeks ago, we covered this concept in detail. We don't want to be overly concerned about a recession that may or may not be coming. We had a recession in the 1988 to 1991 window. It was not a showstopper for the secular trend. The charts, history, demographics, and we can add recent signals support the theory that the 1 to 10 year outlook is highly favorable. And if you don't think that's true, it's hard to say an average 3-year gain of 45% is anything other than highly favorable, and a 10-year gain averaging 171% is anything other than highly favorable. The table on your screen is based on something that just happened in 2023. And if you're a client and you were wondering, the market model is still our primary driver. Nothing's changed. One of the reasons why we haven't been talking about it, it aligns with these charts. It looks very, very strong, and it says we should be fully invested or extremely close to fully invested in this environment. For example, the trend strength model, that component, it's been hovering between 98 and 100. The secular trend modeling that we're working on doesn't replace anything. It's a supplemental tool that we believe will help us make better decisions with the volatility drawdown trade-off. How much rope are we willing to give these positions? When do we hit the uncle point in this environment with higher inflation, higher interest rates, and potentially higher volatility, but within the context of a longer-term bullish trend? Bullet point number 1 and bullet point number 2, they both help us with the all-important question, is this volatility to ignore or volatility to respect? Until proven otherwise, the longer-term base case is a secular bullish trend driven primarily by demographics. And our goal is to navigate to the right side of the table. What does that mean? This is the right side of the table. And what it means is, in this environment, we shouldn't be as concerned about the left side of the table, 1 month, 3 month, 6 month, 9 month. And we should be more concerned with capturing what could be very favorable long-term returns. These numbers tell us that we have a strong secular trend based on the data that we have in front of us and based on things that have just happened. All of that, of course, is subject to change. It's important to know our time frame. In this environment, our time frame is not the left side of the table, it's the right side of the table. And the default stance with the charts that we have in front of us today is to err on the side of not fighting the primary trend. And history says, most likely there's going to be cyclical drawdowns that will require some defensive action along the way. One of the reasons why we can do work on this now, secular trend is set to be in place potentially until 2034. And the market model is telling us the current trend is strong. Hence, not a bad time to work on something like this. This look and the other yellow arrows on your screen, this look and the other yellow arrows on your screen tell us, based on what we know today, we're still in a position where it appears there are very favorable long-term opportunities, next 1 to 10 years. And if you've been hesitant to get started, that's how you should feel here. That's actually bullish. We had this first pullback here, and everybody became bearish very, very quickly. That's exactly what we want to see in this environment. So if you're interested in getting started, there's a lot of information on our website. The weight of the evidence tells us we're trying to navigate between a point A and a point B that could be several years down the road. And we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.